Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. We're diving deep into what has been, well, a pretty chaotic high-stakes week.
Definitely feels that way.
Yeah. So today's mission is really to move past just the noise, the headlines coming from places like CNBC, Bloomberg, Reuters, Yahoo Finance. We want to connect the dots, even the ones that seem really disparate. We're looking at everything from regional bank loan worries and how that's making the Fed maybe pivot, all the way to, like, high-level trade policy and geopolitical summits.
A lot to juggle.
It is, and our goal is to sort of synthesize these things that seem unrelated and give you a clear picture of what it all means for the markets.
And I think if you're trying to understand what's really driving the volatility right now, there's one word that keeps coming up: credit.
Credit, okay.
Yeah, specifically these sudden and kind of escalating fears about credit quality in the banking sector. It wasn't like a sudden liquidity crunch this time.
Right.
It was more of a slow dawning realization that maybe cracks are forming in the bedrock of lending. And that realization, well, it immediately fed into expectations about what the central banks might do.
Okay, let's start right there then, because this credit contagion, as some are calling it, it seems like the biggest market mover this week.
Yep.
Wall Street usually needs more than just one bad headline to get properly rattled, right?
Exactly. And what we saw was a sequence, wasn't it? A sequence of events that sort of exposed some fragility in a place maybe people weren't looking so closely. Private credit.
Ah, okay.
Yeah, that's kind of the key insight here. These weren't, earth-shattering, catastrophic losses hitting the headlines initially.
Right, not Lehman Brothers again.
No, nothing like that. But they were deeply symptomatic. You had Zions Bank Corporation reporting a $50 million loss on just 2 commercial loans. Then Western Alliance came out alleging borrower fraud on a credit facility. Those stories popping up across financial news, they're troubling because they hint at potentially deeper issues with, say, due diligence.
And importantly, these landed right after those bankruptcies in the auto industry space.
That's right. Tricolor, the subprime lender, and First Brands, the parts supplier. We saw big banks like JP Morgan actually taking significant charge-offs related to Tricolor's debt.
So it connects back.
It does. It sort of pulled back the curtain on some of these, let's call them, messy private credit debt agreements.
Okay.
See, unlike public debt, private credit often lacks transparency. The deals are complex, bespoke, often outside the usual regulatory spotlight. So when you see names like Zions and Western Alliance flagging these issues,
It tells you the risk might be spreading.
Yeah.
From those specialized funds, maybe into the regulated banking system itself.
Precisely. And that's where the anxiety really ramps up. You remember Jamie Dimon used that classic analogy earlier this month?
The cockroach one. When you see one cockroach, there are probably more.
That's the one. And you can bet the market was remembering that very clearly this week.
And the reaction was immediate, wasn't it?
Oh, yeah. Fear priced in straight away. Regional bank stocks really led the charge downwards, dragging the main indices down quite a bit on Thursday.
The regional bank ETF, KRE. It's been dropping for weeks now, hasn't it?
4 straight weeks, yeah. This isn't just market chop. It feels like a real institutional move away from perceived credit risk in that sector.
So, okay, bad loans are surfacing. What's the direct link to policy? Jim Cramer was pretty blunt about it, wasn't he?
He was. Analyzing it on Mad Money, he basically said, look, credit losses are the clearest signal the economy's heading south. And nothing gets the Fed moving faster than seeing credit losses pile up in the banking system.
Because lower rates help borrowers. Makes it easier to pay back debt.
Exactly. It's like first aid for a bleeding credit system. It helps borrowers service their debt, avoid default. The market instantly got that the Fed's focus might shift, away from just inflation fighting towards ensuring financial stability.
And we saw that in the betting, the market pricing.
Instantly. Reports showed investors just piled into bets on Fed easing. They're now pricing in, 53 basis points of cuts by year end?
Wow, up from 46 just the day before.
Yeah, that's a huge jump in expectations, basically triggered by a few headlines about regional banks.
And then we heard from Fed governors, too, reinforcing that idea.
We did. Christopher Waller suggested, they can keep lowering rates in steady quarter-point steps. But what caught my eye more was Governor Stephen Millen.
What did he say?
He doubled down on his view that a much bigger cut, like maybe 50 basis points, might be appropriate this month.
50 points, that's aggressive.
It is. So this whole policy pivot idea, it's not just a fringe theory anymore. Morgan Stanley's economists are now saying they expect another quarter-point cut at the October meeting. It feels like the shift is cementing.
Okay, so expectations of easing rates. That naturally pushes investors towards safety, right? The bond market.
Classic flight to quality. Treasury yields dropped further. Investors are clearly happy to accept lower returns for perceived safety right now.
And that benchmark 10-year yield dipping below 4%. That's a big psychological level.
It is. Hit a one-year low, actually. But what's really fascinating is watching where else that risk-off money went, beyond just bonds. It kind of created a split decision.
Between the traditional safe haven and the digital one.
Exactly. Gold versus crypto. And they rarely react the same way in a real credit scare.
So how did it play out this time?
Well, gold, the old reliable, it's soaring, having its best week since March 2020, actually.
Wow.
Yeah. Fundstrat's digital assets guy, Sean Farrell, he told Yahoo Finance that capital is clearly favoring gold. He pointed to its momentum, lower volatility profile.
Makes sense.
And he also mentioned structural buyers like central banks give gold a kind of quasi-backstop.
Okay, so gold wins. What about Bitcoin?
Bitcoin got hammered. Absolutely hammered. It plunged from around $121,000 down to like $105,000.
And that was tied to Trump's tariff threats on China, a policy move.
Directly. The threat of 100% tariffs. You might ask, why does a threat about physical goods hit a digital asset so hard?
Yeah, why?
It comes down to the crypto ecosystem itself, particularly derivatives. Ed Yardeni explained it well. Think of derivatives as leveraged bets. You
Right.
borrow to make a bigger bet.
Okay.
So when the Bitcoin price started to wobble because of the tariff news, it triggered automatic sell orders, margin calls, basically a cascade across that leveraged ecosystem. Liquidity just vanished.
The domino effect.
A massive one. Over $19 billion in futures and leverage positions apparently got liquidated. So the initial fear got magnified massively by all that leverage. It really showed that Bitcoin, well, it still doesn't have the stability of gold in a true risk-off moment.
That's a really important point for anyone holding crypto. Okay, switching gears, but staying with financial stability. There was a huge regulatory U-turn this week, too, wasn't there? Raises some long-term questions.
That's right. The big U.S. banking regulators, FDIC, OCC, the Fed, they jointly announced they're scrapping those rules that required big banks to plan for climate-related losses.
Why would they do that now?
Well, the official line is that the existing safety and soundness rules are good enough. Basically, banks already have tools to manage any unusual risk, whether it's climate or something else. Governor Michelle Bowman framed it as refocusing on, immediate financial risks.
But not everyone agreed.
Not at all. And this is critical. Governor Michael Barr, he dissented sharply, called the decision short-sighted.
Short-sighted, okay.
His argument was basically, by ignoring a known, growing, systemic risk like climate change, the regulators are actually making the financial system riskier. It really highlights this internal tension, maybe even political tension, over the scope of regulation right now.
Speaking of charged politics and targeted policies, let's pivot from the big picture monetary stuff to specific White House moves that are shaking up certain sectors, starting with healthcare.
Yeah, the pharma sector got hit with a sort of 1-2 punch this week. The first was focused on IVF treatments.
By making them more accessible.
Exactly. There was this deal detailed with Germany's Merck KGaA, their EMD Serono unit.
And it involved tariffs, didn't it?
Yeah.
A trade-off.
It did. Classic carrot and stick. Basically, in return for relief from some threatened pharma tariffs, Merck agreed to slash the price of its fertility drugs, like Gonalf, which is widely used.
How big a cut are we talking?
They promised an 84% discount off list price for a typical IVF cycle using their main drugs. The goal seems clear: bring down the cost of a procedure that's often incredibly expensive, $15,000 plus, and usually not covered by insurance.
So using trade threats for consumer relief at home.
Seems like it. But the bigger shockwave in the market came from comments about weight loss drugs.
Ozempic and the like.
Exactly. Shares of Novo Nordisk, which makes Ozempic, and Eli Lilly, maker of Mounjaro, they both dropped pretty sharply after the president suggested the cost of these GLP-1 drugs could potentially fall to just $150 a month.
$150? That's huge compared to current prices.
It is. Current list prices can be over $1,000 a month, so that comment alone sent Novo shares down over 5% in Europe. Shows how sensitive that sector is to policy talk.
Did they clarify that figure? Because it sounds almost too good to be true.
They did, thankfully. Mehmet Oz, who runs Medicare and Medicaid services, quickly stepped in to say, look, $150 wasn't a done deal. It was more like aggressive posturing and ongoing price negotiations.
Okay, so negotiation tactics.
Right. But as analysts pointed out, it definitely signals the administration plans to play hardball on drug pricing going forward.
Okay, away from pharma, there was action on the labor front, too, related to visas.
Yes, the U.S. Chamber of Commerce filed a lawsuit. They're challenging that new, very steep $100,000 fee the administration put on H-1B worker visas.
$100,000 per visa. Wow. What's the argument against it?
Well, legally, they're saying the fee is unlawful because it kind of overrides existing immigration law. But the economic argument is maybe more important for listeners.
Which is?
That it would be cost prohibitive, especially for startups and smaller businesses, big tech firms.
Yeah.
They can probably swallow that cost. But smaller companies, the ones often driving innovation, who rely on skilled engineers from places like India and China, a fee that high could just freeze them out of hiring that essential talent. So the lawsuit is trying to protect that innovation pipeline.
Okay, let's broaden out again to geopolitics. Sources suggest tensions are really high, especially around Ukraine, heading into the weekend.
Yeah, definitely dominating the agenda. President Trump announced he's going to have a second meeting with Vladimir Putin, this time in Budapest. And he's also meeting with Ukraine's President Zelensky today at the White House.
So, high-stakes diplomacy. Are there specific pressure points being applied?
Seems like two main ones on Russia. First, military leverage. There are reports mentioned across the news wires about potentially supplying Ukraine with long-range Tomahawk missiles.
Tomahawks. That would be a step up.
A big one. The Kremlin has already called that idea a serious escalation. So that threat is clearly being used strategically, perhaps, to push Putin towards negotiation.
And the second pressure point, is it financial?
It is, yeah. Centered in Europe. EU leaders are pushing for faster action on using the cash generated from those frozen Russian assets. We're talking about the balances linked to around $204 billion or $175 billion in assets that have matured.
Using Russian money to fund Ukraine's defense.
That's the idea, but it's legally very tricky. Most of these assets are held by Euroclear, the clearinghouse in Belgium.
Right.
And their CEO, Valerie Urbain, has been quite vocal, saying they have to respect the rule of law. They need to maintain international investor confidence in Europe.
Because if Europe just starts seizing sovereign assets.
Exactly. It could really damage its reputation as a safe place for global investors to park their money. It's a really delicate balancing act.
Okay, finally, let's talk global trade shifts.
Yeah.
President Trump's tariffs, they've obviously had a huge impact. How's China weathering that storm?
Well, the data suggests China's showing surprising resilience, actually, even while taking targeted hits.
Resilience.
Their customs data show that even though sales to the U.S. dropped significantly, overall exports still grew 7.1% in the first 9 months of this year.
So where are the goods going instead?
They've executed a massive pivot. Exporters making everything from appliances to electronics, they're aggressively targeting Europe, Latin America, the Middle East, Africa. You hear stories about companies that used to rely heavily on the U.S. market, now basically writing it off and focusing elsewhere.
Sounds like they're adapting. But is it painless for those Chinese companies?
Oh, far from it. This big pivot means they're all rushing into the same new markets, which creates fierce competition.
Driving down prices.
Exactly. Prices are getting eroded badly. Reports say manufacturers are often selling at razor-thin margins, sometimes even at a loss, just to keep market share. As one exporter put it, the demand increase in these new regions just isn't enough to fully replace the lost U.S. demand. It's a painful adjustment.
Okay, one quick counterpoint on trade, though, relief for U.S. automakers.
Yeah, apparently the White House is close to announcing an easing of tariffs on imported auto parts, extending a deal that lets automakers reduce duties. That's aimed at helping the domestic giants like Ford and GM manage their costs. #outro.
Okay, so let's try and pull this all together for you. The really crucial theme this week seems to be credit, doesn't it?
Absolutely. Credit risk is the spark right now. It translates immediately into higher expectations for Fed rate cuts.
Which pushes down the dollar, pushes down bond yields.
And turbocharges gold. But at the same time, you've got these very targeted policy moves from the White House on the geopolitical stage.
Right, impacting specific sectors like healthcare, labor, global trade flows.
Exactly. So you need to watch both the macro fallout from credit and these specific sectoral pressures for risks and, well, maybe opportunities too.
Makes sense. A lot to track. Do you have a final thought for us? Something maybe looking a bit further out?
Yeah, actually something that transcends this week's news but connects to the bigger picture. Copper.
Copper. The metal.
Yeah. Think about the long term. Demand for copper is projected to surge, maybe up to 40% by 2035. Why? Think AI data centers, increased defense spending, and the massive energy transition, EVs, solar, wind. It all needs copper.
Okay, demand surge. What's the problem?
The supply chain is incredibly fragile. The CEO of the London Metal Exchange highlighted this recently. If governments around the world don't act decisively now to diversify supply sources and, crucially, build more smelting capacity,
Okay.
then copper, the essential metal for electrification, could become the metal of scarcity. And that would have profound impacts on inflation, industrial growth, the whole green transition for maybe the next decade or more. It's a potential structural bottleneck worth thinking about.
Wow. The metal of electrification becoming the metal of scarcity. That is definitely something to keep an eye on long term.
Yeah.
A critical watch indeed. Thank you for walking us through all that.
My pleasure.
Okay, that was a heavy dose of financial news for your Friday. We hope breaking it down helped. Now we'll see you all Monday morning with new headlines from major financial magazines.